Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. Okay, in today's episode, which I'm actually recording in video for the first time, so we'll see how that goes. So if for whatever reason you want to watch it, it's on YouTube. But anyway, today I want to talk about why PAYGs should think differently about tax planning. And, the common thing that we get when we get approached by prospective clients, particularly PAYG clients, is they tend to think, gee, we're paying a lot of tax. It's a big sort of tax burden, and we'd love to figure out a way that we can legally reduce the amount of tax that we pay. And so they then naturally move into the question, what can we do? What are some of the strategies that PAYGs can employ to reduce the amount of tax that they pay? Now, of course, it feels like you're carrying a large tax burden, and that's because you are. As individual PAYGs or individuals in Australia, they contribute about 51% of the total tax revenue, which is twice as much than what companies pay. So companies contribute about 24% of Australia's tax revenue. So certainly individuals are doing, unfortunately, most of the heavy lifting. Now, of course, as an individual, you go, well, that's unfair. Companies are making billions of dollars. They can afford to pay a higher rate of tax. But actually, increasing the corporate tax rate actually has some long-term negative consequences associated with that. Other than kind of hopefully fairly distributing the tax burden, the reality is it's not actually going to do that because it will slow the economy, it will reduce investment and so forth. So, one of the things we want to do is make sure that Australia is an attractive investment proposition for overseas capital, and tax regime is a big part of that. Also, the more you tax businesses, the less they can grow. So if they pay less tax, then as a business, you can either pay out a dividend. And if you pay out a dividend to shareholders, hopefully shareholders go and spend or invest that money in Australia. If you don't pay out a dividend, then hopefully you can reinvest it in your business, either capital improvement, expanding the business, buying another business, those sorts of things, or grow the workforce. Either way, the economy benefits, and what you're then doing is growing the tax base. And that's actually a better outcome than taxing, companies at a higher rate just to try and equalize the amount that individuals and companies pay. And the same really, though, with individuals. The more you tax individuals, the less money they have to spend and invest. And that has economic consequences as well. So, the same approach can be taken. And that's why a lot of developed countries around the world have been gradually reducing their reliance on income and company tax, and instead of using more sort of consumption taxes like GST. And consumption taxes are harder to avoid, of course. But the problem is for lower income earners, they're paying a proportionally higher amount of tax because a lower income earner is probably going to spend most of their income on staples, power, on food, on health, these sorts of things. They might be spending, 40% of their total income on those sorts of expenses, where very high income earners might only be spending 10%. So proportionally, that's the problem with consumption tax, is proportionally their lower income earners are paying a higher rate, although you can provide rebates, and certainly there's countries around the world that do that relatively well. Having said all that, the bracket creep, I should say, bit tongue-tied there. The bracket creep in Australia is insidious. So, the average tax rate is the highest it's ever been, and is expected to continue to escalate. And I've got a link in the blog on the website to a chart that sort of illustrates that. So certainly individuals are wearing a large part of the tax burden, and we don't expect that to change anytime soon. The problem with tax planning for PAYG individuals is twofold. Firstly, they have very little control over the timing of their income and the structure in which they receive that income. So even if you set yourself up as a contractor and try and pretend that you're a business, the personal services income rules will generally prevent you from distributing that income out beyond yourself. So personal services rules means that if the income is a result of my direct personal exertion, then the taxable income, even if it comes through a company or trust, has to end up in my name. And as a result, you end up paying the same amount of tax than if you were a PAYG individual. And so it all comes into our personal name, and we've got no control over the timing. The second issue is that there's no real meaningful tax deductions that a PAYG employee can claim. Now, there's a general rule that you can claim up to $300 a year in work-related expenses without necessarily keeping receipts. But if you go over that, you need receipts. The government has proposed to change that benchmark, increase it to $1,000 by the start of next financial year, but that's not law yet. But it's not really going to move the needle, right? $1,000, $300 deduction, it's not really moving the needle for most people. And if you want to move outside of those limits, there's a lot of substantiation that's needed. You need to use prescribed methods, maybe logbooks, these sorts of things, keep a lot of receipts. It's a really challenging thing, even if you do have some legitimate tax deductions. And so they're the reasons why tax planning is so difficult. We can't sort of move the income, and there's a lot of tax deductions. And really this means that essentially there's only two ways that a PAYG can really move the dial in terms of the amount of tax that they pay. And the first one is superannuation, and the second one is negative gearing, so borrowing to invest. So let's talk about those, because certainly those two things, they're the things that we'd like to explore first. And then I'm going to talk about, well, what can you do? What can you focus on to hopefully achieve some better outcomes net of tax? Okay, so superannuation, we're talking about concessional contributions here. So they're the contributions that you claim a tax deduction for. They're going to include employer contributions, which are made on a pre-tax basis. So that's the 12% compulsory superannuation, of course. And then you can salary sacrifice in addition to that, or make personal contributions, so ad hoc contributions at any time throughout the financial year. But they've got to be within a cap. So the cap is $30,000 a year. That's the most amount of concessional contributions that you can make. That cap is indexed in $2,500 increments, and it's indexed to average weekly time earnings. And so I predict that on 1 July 26, that cap should hopefully increase from 30,000 to 32,500, but that continues to be indexed and will be indexed. Now, the benefit of that, the tax benefit of that, is that if your adjusted taxable income is less than $250,000, then you're going to save around about 32% in tax. Because if you are earning over 190, between 190 and 250, you're paying 47% tax, whereas your contributions are taxed at a flat rate of 15%. And so that's where the 32% tax differential is. If your income, adjustable taxable income, is more than 250,000, you'll pay an additional 15% tax. So that is, your contributions are taxed at 30% in total. That's called Div 293 tax for those that are aware of it and paying it. And that means still there's a tax benefit, but the tax benefits shrunk to 17%. Still worthwhile, but just not as good as someone on a lower income. And unfortunately, there's no way around it. Like, there's no way that you can avoid Div 293 tax other than earning less, of course, which I wouldn't recommend. If your super balance is less than $500,000 at the beginning of the financial year and you haven't previously used those concessional caps in previous financial years, you can go back up to 5 years to utilize those caps. So again, this can create a really useful tax planning opportunity. For instance, in a year that we expect if we expect our client, for instance, to crystallize a capital gains tax event next year, or receive a really large bonus next year, either way, their taxable income is going to be higher next year. What we might do is opt not to make any additional super contributions this year if their balance will remain below 500,000, and preserve and carry forward that cap into the following year to offset any capital gains tax or larger tax burden, bonuses, those sorts of things. So using those carry forwards can be a bit of a tax planning opportunity, particularly if you've got some lumpy income or lumpy taxable income more correctly. Okay, the second way is negative gearing, of course, something I've spoken a lot about in this podcast. And really that occurs when you borrow to invest in an asset, typically a property, and where your expenses associated with that investment, including interest, larger than the income that you receive, so you make an income loss, and you can offset that loss against other income such as PAYG income, often referred to as negative gearing benefit. Now, I want to be really super clear here that negative gearing is not a tax strategy, or maybe more correctly, negative gearing should never be used as a tax strategy. It's a wealth building strategy, right? So the goal isn't just to lose money for the sake of it. It's to really grow your wealth over time. And the assumption is that, yes, I'm making a loss every year, but the compounding capital growth that's going to occur over the long term will more than compensate me, a lot more than, hopefully many-fold, in terms of return relative to the negative cash flow loss. So negative gearing, sometimes people speak to us and go, oh, okay, I want to buy an investment property because I'm paying too much tax. Well, no, you want to buy an investment property because you want to build wealth. And a positive consequence of that is that it will help you save tax. So it's really important to make sure that, you don't, and negative gearing aside, it's really important to ensure that you don't base financial decisions purely around tax outcomes. What you ultimately want to do is think about what are the decisions you can make that are going to improve your financial position net of tax, because tax is only one element, of course. Okay, so really how I like to reframe the question when PAYG clients ask us about tax saving is I like to reframe the question and say, look, there's a couple of things you can do, the super and negative gearing, but once you've done that, forget about income tax, right? It is what it is. You're not really going to move the dial. Instead, all your energies and focus should go towards making sure you're investing as tax effectively as possible. And that's really where I think the low-hanging fruit is for most PAYG individuals. Okay, I'm going to have to pay tax on my income, but let's make sure that I'm not going to pay too much in capital gains tax and income tax on what my investments produce. And a few months ago, I wrote a blog about, fully utilizing the benefits of super. And I highlighted that each individual can have up to $2 million inside super and not pay any tax. So that means you're not going to pay any tax on the pension income that you withdraw from super. You're not going to pay any tax on the investment earnings, and you're not going to pay tax on any capital gains that you earn. That means that a couple, for instance, can have up to $4 million of investment assets inside super that's completely tax-free. Now, so that's pretty compelling, right? I mean, that's probably the best environment that you're ever going to get. And of course, the government could play around with these tax rules, and I'm sure that they will in the future, but it's always going to be concessionally taxed. So they might play around with the caps and whatever, but I think for most people, the risk that they change the rules so much that it becomes unattractive anymore is very, very low in my view. Now, the challenge with super though is that whilst it's really tax effective, there's set limits in terms of how much we can contribute. So I spoke about concessional contributions, the $30,000 a year, soon to be $32,500 a year. But in addition to concessional contributions, we can make non-concessional contributions. They're after-tax contributions, really moving monies that are in our personal name, savings, so forth, into super. And we're limited each year on how much we can move into super. It's $120,000 a year, or if your balance is less than 1.7-ish, a little bit more than 1.7, it's 3 times that amount. So 360,000 in one hit. If you carry forward, 3 years of contributions in one, which you can do. Now, because we've got these limits, you've really got to plan out ownership structures carefully. And you've got to think about, okay, if you're in your 30s and 40s, you don't necessarily want to put all your eggs in one basket and invest all the money inside super. And I understand that, and I think that's correct. But also, as you move closer to 60, which is when you can access super if you're retired, and 65 even if you're working, as you move closer to your 60s, you should want to start tilting most of your assets into super, or moving more of your assets into super more correctly, especially to maximize that transfer balance cap, that $2 million per person that is going to be tax-free. And so you want to then think about, how am I owning assets today, and will that allow me to tax effectively move those assets into super in the longer term? And that could be things like using family trusts and so forth, which I'll talk about in a second. The other thing that is really important to be mindful of is that the transfer balance cap is indexed. So that cap is going to increase. So if you're not going to retire for 10 years, it's likely the cap will be $2.5 million by the time you retire. So if you've got a spouse, that's $5 million between you. And if you're 20 years away from retirement, it's likely to be about 3.2 million. So that's 6.4 million between spouses. So it's something that, from a planning perspective, we certainly take into account. And we would like, if our clients have a certain amount of wealth that's not exceeding the transfer balance cap, so the 4 or 5 or 6 million, depending on when they're retiring, then we want all that money money to be in super eventually. Now, it doesn't necessarily need to be in super on as soon as you turn 60 or as soon as you turn 65. It might take a few years to get it in there, but that's cool. It's really just about, it's not the end of the world if, it takes you to 67 or 68 to get it all in there. But the more you can get in, the more tax effective it's going to be. The other major tax planning opportunity, not only for PAYGs, but really all Australians, is the main residence exemption, the main residence capital gains tax exemption. So that and super are really the only two things that in life can be sort of tax-free. And, it's really important to think about, even if your strategy involves rent vesting, which means renting where you want to live and investing elsewhere in property, you still should, in my view, put a lot of weight towards hopefully maximising the CGT exemption that a main residence will give you. And you might be able to do that using the 6-year rule. I know Mina and I recorded a podcast on the other podcast I co-host, The Holistic Accountant, where we spoke about the 6-year rule and how to use that and all the conditions and so forth and that sort of stuff. So certainly check that out if you're rent vesting, you want to sort of utilize that exemption. But the other way that it can be utilized is, using the home as an investment vehicle as well. And I've seen this really used exceptionally well in some circumstances. And this typically involves a downsizing strategy. So individuals might go, well, we're going to go and buy this family home. It's in a fantastic area. It's an investment grade asset. We're going to live in that property for 10 to 20 years. When the kids move out, we need, a smaller residence, we're going to downsize. And because we're going to downsize, we're not going to concentrate as much on debt reduction because we know we've got a debt exit strategy. And essentially, we're going to put all our eggs in one basket. Essentially, you've still got super and other investments, hopefully, but that downsizing strategy can work really well. And that's by utilizing the main residence exemption, the fact that we're not going to pay any capital gains tax on the capital gains in our family home. The last thing that PAYG individuals to start thinking about is investment structures. And really, this is how are you investing outside of superannuation? So we've spoken about superannuation, how attractive it is, but what are you doing outside of that environment and how effective is that? Now, one of the things that I've shared before on this podcast is I look back is I think I've been too conservative at times with advice with respect to fees and structure and complexity. Now, if I set up a family trust, yes, there's some complexity there. It's not that big a deal. It's just a trust. So I wouldn't say it's hugely complex, but it's not as simple as not having a trust, of course. And that there's ongoing running costs associated with that trust. It might be $2,000 a year or something, $2,500, whatever it might be, but there's an ongoing cost. And so quite often, or in the past, more correctly, maybe 10, 15 years ago, if I didn't see that I'm going to get a payback period relatively quickly, that I'm not going to be better off in 5 years, for example, then I've been inclined to say, let's not have a trust. Let's keep it really simple. Let's avoid the cost. But with the fullness of time and seeing investments compound and the taxation consequences that creates, over the last few years, I've been taking a broader approach to this in terms of a longer term approach. And so I think if you're going to acquire substantial investment assets, firstly, those assets will compound over a longer period of time. And it's difficult to even get your head around how compounding works or what those figures could look like in 10, 20, 30 years from now, but they could be substantial depending on the starting balance and contributions, of course. And then the other thing that's really difficult to get your head around is the future changes. How will your situation change and will these structures accommodate that change? And so more today, I'm leaning towards, introducing structures like a family trust and a corporate trustee, a corporate beneficiary, I should say, to create better tax planning opportunities. So let me explain how that would work. So obviously, PAYG earns income, pays tax, has some money left over to invest. So that's after tax dollars. We would then contribute that money as a capital contribution into a family trust. A capital contribution means that we'll get some level of asset protection because the family trust owns the pool of assets. I no longer own it anymore. You can lend it into the trust, but making a capital in corpus contribution provides that asset protection. And then I accumulate assets in this trust and invest it in the share market and whatever it is. If I then earn income, investment income, and also potentially capital gains, because it's in a family trust, I've got flexibility where I want to distribute that. So in a year that my spouse doesn't earn much income, I might distribute to that person, to my spouse. If my kids are now 18 years old and uni, not earning much other income, I might distribute to them. Or if I've got no one really to distribute to, I can distribute to what's called a corporate beneficiary, which is a company that's a beneficiary of the trust, but the shares in that company are also owned by the trust. So essentially you can park the money in the company and then in the future potentially pay a dividend out of that company into the trust and then use your discretion of where that dividend goes again. So it's a bit of a kind of a round robin. But look, this is not tax advice. In fact, none of this is financial tax advice in this podcast, but there are structures out there that you can talk about to your advisor, with your advisor and your accountant to make sure that if you're PAYG, you're going to pay a lot of tax. Let's make sure you're not going to pay too much tax in the future. But the overarching goal really is exactly that, is to use super, is to use the main residence exemption and to use tax effective structures to make sure we're taking that after-tax cash flow, investing it well. So we want to make sure we make some good quality financial decisions, maybe introducing, of course, maximising super, introducing some gearing, but then beyond that, tax effectively building assets outside of super and outside of the family home. So to wrap up, really the bad news is that there's not a lot you can do as a PAYG earner to reduce your tax other than super and negative gearing. And so therefore, the best thing to focus on is making sure you make some really smart decisions with respect to how you're investing your money. And the key thing I'd like to leave you with is don't be too cost conscious, which is not to say that you should, flagrantly pay sort of any fees and give rise to any cost and complexity, because I've seen it go too far the other way as well, where you've got too much complexity and there's no benefit for it. But really it's just being conscious about or taking a longer term view to say, look, if I'm going to build a substantial pool of assets, I certainly want some taxation flexibility associated with that. Okay, so let's get into some questions today. First question is from Michael. Thanks for my podcast. Michael's 53, wife is 45, 3 kids, 16, 11 and 6, live in Mackay. His income's 250, wife's income's 50, so 350 family income. Super between them is about 1.15, so Michael's about just under 900 and the wife has 250. They have ETF portfolio, mostly Vanguard ETFs, all Vanguard ETFs actually, 290,000. Home's worth 1.25, and they've got an investment property in Mackay that is worth 900. They paid 50 in 23, so it's done really well. Rents for almost $800 a week, which is pretty high. They get some depreciation benefits. Obviously, it's a new property as well. And they've got 110,000 in the offset account, and they've got $8,000 to invest per month. That's 1 minute rundown of Michael's situation. Very quick. Lots of numbers there. 2 questions. What should I do with the surplus cash flow, and should I sell the investment property? Okay, so what should you do with surplus cash flow? Well, the first thing I'll look at is if Michael wanted to retire before 60, can he do that? Well, he's got the share portfolio, 300,000, and the investment property, and then another 100,000 of money in offset. So I think he's getting pretty close to not necessarily needing to acquire or accumulate more assets outside of super. He's getting pretty close. Even if he works for another 3 or 4, 5 years, those assets will compound. And of course, this is all interrelated with the property decision too. So I think because of those reasons, I think what I'd be focusing on is making non-concessional contributions into the wife's super, try and balance out these balances a little bit. And really, the thing is that Michael's 53, so theoretically he can access his super in 7 years. So putting more money into super isn't a big deal. Yes, his wife's younger at 45, so 15 years away from super. So if we put more money into her account, it's locked away for longer. But that doesn't worry me because I can still convert Michael's account into pension and draw more aggressively from that if I wanted to. So it's really about who is the older spouse, the first that's going to access super, and what is their balance. And as long as they've got a healthy balance, then we don't really need to worry about if there's a differential in age and therefore a differential in being able to access super. So for those reasons, I'd probably concentrate on super. If you weren't comfortable doing that, then you might do like a 30-70 split. So 70% of your surplus cash flow goes into super and 30% goes into the ETF portfolio that's in your wife's name. And then maybe in a couple of years' time, you switch to 100% focus on super. Now, what should you do about the investment property? Well, I mean, common sense or some level of common sense would say, why would you sell it? Like, you bought it a couple of years ago for 650, it's worth 900 today. That's a huge gain. I mean, it is a huge gain. $250,000 in such a short period of time is a tremendous outcome. Michael, I shouldn't have mentioned, Michael said it's only costing about $500 a month to hold. So the negative cash flow is relatively low. Look, that would tell me, and particularly given the rental income $795 a week, $800 a week, that would tell me it's a new style property. We've spoken a lot about scarcity, about land value component, all those sorts of things. Also, I did an episode last week talking about the last 5 years of data and how you shouldn't allow it to skew property decisions. And cue Michael with his question, so it's perfect timing with respect to that. So, there's a lot of things that have happened over the last 5 years, as I said last week, that won't necessarily repeat themselves in the future. So what should you do? Should you take your money and run? Look, I'd be inclined, but this is not advice because I don't know the property. I haven't looked at the property. I don't know if there's something unique about your circumstances that I'm not aware of today or unique about the property. But yeah, I probably would be inclined to say, look, I've made a really good gain here. Let's take it off the table. Michael asked about, potentially if I sell, in a just before end of financial year, sorry, just before at the beginning of a new financial year, then I delay when I need to pay the capital gains tax. Look, I don't know if you can be that perfect with it in terms of timing of property sales. And this is not only for Michael, and this is a general comment. Taxation outcomes and when you might need to pay that tax is only one of many factors you need to consider when divesting of an asset. So I think a more important consideration is the timing with respect to the market. What is the property type? Who is the likely buyer? Is there a particular time of year that's best to sell these assets? And how the market is going at the moment. Is the market only just picking up pace? So I reckon if I delay the sale for a year, I'll be better off. Or is the market really hot at the moment, in which case let's get it on as soon as possible. So I wouldn't worry so much about timing of crystallizing that capital gains tax liability when you need to pay that tax. I'll be more guided by when is the best time to sell the property. Now, the question then becomes, what do you do with the equity that you pull out net of tax from the property sale and therefore also the increased amount of income that you can invest? And Michael's asked, should I replace it with a better quality asset, say a property in Melbourne? Well, that really depends on your goals, Michael. You're 53, wife's 45. Kids are still relatively young, like your youngest is 6. So I'm going to take a guess you're probably going to work for another 10 years. That means your youngest will be 16, and maybe around that time you'll start thinking about retirement. Oh, okay. Sorry. Later on didn't read the full question, is about 10 years. So 10 years really isn't long enough time horizon. In 10 years, the property's still going to be costing you money. And the only way that you're going to make it positive cash flow is putting money in the offset account. But that comes at the opportunity cost of investing in other growth assets. So the problem is here that if you go and sell the Mackay property and then reinvest in the Melbourne market, that what you'd need to do then over the next 10 years is start putting maybe 50% or more of your surplus cash in the offset account to really reduce the amount of debt against that asset and then make it positive cash flow by the time you get to in 10 years' time, by the time you get to retirement. And whilst that mathematically, like if we compared outcomes of, say, doing that versus not replacing the investment property in 10, 20 and 30 years' time, well, certainly 20 and 30 years' time, the investment property is going to generate more wealth because of the compounding capital growth and the gearing. So it is a superior financial strategy, but does it fit into your circumstances? And I'm not sure it really does. If we think about what will happen to your super balances over the next 10 years, I think broadly you can go, well, 7.2% returns, your balance doubles. So let's just assume that your super then, with some contributions, will be circa 2 million. In 10 years' time, the transfer balance cap, which is the amount you're able to have that's tax-free, will be about 2.5 million. So you'll still be in that tax-free environment. Your wife, without material contributions, might be 500, 600,000. So there's a bit of a gap there in terms of utilizing the tax-free benefits of super. And so I think sell the property if you agree or form the view or share the view that the future returns aren't going to be nearly as good as the past returns over the last 2 years. I would divest of the Mackay property, take your money and run, make a non-concessional contribution into your wife's super, continue to build the ETF portfolio, but really focus on super and hopefully get to a stage where, I haven't done the numbers and whether this is even possible, but hopefully you get to the stage where you both have $2 million of super in 10 years from now and you're off to the races. You're in a really strong position. It's a really tax effective way to build wealth and you don't need to worry about property investing, land tax, tenants, all those sorts of things. Not talking people out of property investing, but it is very different to share investing. And, anyone that owns property will share my frustrations. Well, not if they're frustrations, but viewpoint in regards to that. So, but thanks for your question, Michael. Hopefully that's been useful and hopefully these answers are useful to, everyone out there that is in a similar position as Michael. Okay, final question is from JP. JP gave me some great feedback about the podcast, so thanks, JP. The question comes off the back of an episode that I recorded back in April 23 called The Typical Life Cycle of Investor. If you need to find any of these, just Google Pro Solution Typical Life Cycle of Investor. So the heading and it will typically take you to the blog and therefore the podcast. And I wasn't using podcast episode numbers back then, so that was a bit of a pain. So apologies. Anyway, it's come off that. Essentially, JP's situation is they're in their early 30s, very strong family income. He earns 700, wife 100. No kids yet, but want to have kids in the next 2 to 3 years and have 2 to 3 kids. They currently live in a home that's fully offset, that's just a single fronted home in a good suburb in Melbourne, worth 1.5. They bought their forever home for $2 million and they likely do a substantial renovation, about another $1 million, and eventually move into that property. And they'll work out what to do with the current family home, whether it's to sell it. Combined super 250, no other exposure equity, so pretty clean situation. And he's really wondering what should he do with cash flow over the next 3 to 5 years. Should he build a buffer in the offset accounts, to provide for, renovation and the eventual non-tax deductible nature of that debt when he moves into the forever home? Should he invest in shares or should he buy another investment property? And look, typically the goal is to acquire as many growth assets as possible, but you've got to be conscious of debt and keep that manageable, and then also conscious of the split between deductible and non-deductible debt. So at the moment, JP's only got tax deductible debt because the property's living is fully offset. The loan against that is fully offset. So there's no non-deductible interest there. And just the one that he's going to move into eventually has the deductible interest element. And so putting money in the offset account, sometimes the pushback around that is, oh yeah, but I'm going to reduce my negative gearing benefits, which is true. But of course, you're also reducing your outgoings. And you're building equity in the property and you're building cash as well. And let's not forget, the best thing for JP would be that in the future, he rips all the money out of the offset in the home that he's living in, puts it all in the offset in the upgraded property, the current investment property, and funds the renovation completely from that cash. And that'll allow him then to hang on to both assets, assuming they're good quality assets. And that's going to be, to my mind, that's got to be the goal. What can I do today so that when I make that move, I don't have to sell my existing asset? Not that it's the end of the world because you can always replace it, but it'd be great if we could keep both those properties. And the clear way to do that is to put money in the offset account. So I would be focusing on building that cash buffer. And what you're really doing is preparing yourself for the fact that you're going to move into that property and that debt is now going to be not tax deductible. So the debt on the property, I'm going to assume he borrowed the full cost because it cost about $2 million. So I think he's probably got about $2 million of debt against that. Sorry, 2.1. I saw it later in the explanation. So there's quite a bit of debt there to offset, although JP's got quite a high income. So he's going to be able to make some significant inroads. I'm not sure I put 100% of my surplus cash flow into offset. I still think that you're young, pre-kids, you've got capacity and it probably is important to build more growth assets as well. So I'd probably go something along the lines of a 30, 70, 50, 50 split. So maybe 30 to 50% of your cash flow into shares, remembering that you just want to be careful there that, avoid those very lofty parts of the share market in terms of large cap stocks in the US. I saw a chart this morning that the top 3 stocks, Nvidia, Microsoft and Apple, are now 22% of the index, and that's pretty crazy. So be careful there, but start building some growth assets. And JP did say that like to have kids, and that his wife would probably stop working until the kids are school age. So you probably do that share investing in your wife's name, and then the 70 to 50 to 70% of that surplus cash flow into the offset account. Yes, it's going to reduce your negative gearing benefits, but it's not going to move the dial that much over the next 5 years. And what it will do is make sure that you put yourself in the strongest position as possible to be able to hang on to both those assets. But if push comes to shove or your situation changes and you need to sell that existing asset, it's not the end of the world. Okay, that's what I do in your situation, JP. Thanks for writing in, and thanks for everyone that writes in. Of course, keep those questions coming, questions@investopoly.com.au. And until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.